Hey everyone, Douglas here, and welcome back to the MMT Macro Trader and this market recap on one of the more spectacular market days that we've seen, at least in the equity space. Really across the board, we saw some massive moves, but of course the equity space is what stole the headlines. S&P up over 5%, NASDAQ up over 7%, really the biggest move that we've seen, I believe, since the rebound moves that we were seeing post the COVID sell-off. So big numbers today. Of course, it all got kicked off by that CPI data that came out at 8:30 this morning. And then, what ensued afterwards was just a nonstop climb higher. I'm going to go over kind of my thoughts on it. I'm also going to show some of the main models that I use to trade with. Finally seeing some activity take place in those models, and I'll kind of give you what I think is going to happen going forward, at least in brief summary. Real quick though, in terms of the implication of today, and really the implication going forward, I guess, let me just kind of make an argument, make a case for a very bullish run here. We've seen some reasonably strong builds on the fiscal flows. We've seen a really, in my eye, an oversold market relative to, especially where kind of the fiscal activity has been. We've seen sentiment extremely low. We've seen hedging activity from put selling or put buying quite high this entire year. I really would have thought that really maybe going back to June, that we might have seen that June low that we had, we might have seen some more opportunity for a bull run to finally materialize, but it just hasn't. So I think you could make the bull case that this is just an undersold market or an oversold market that is kind of setting up for a massive mean reversion style move. The other piece to this too is with the higher rates that we've had, I mean, that fiscal flow from that rate, right? The actual payment that has to occur from the new bonds that are being issued at the higher rates, it's starting to hit the private sector savings, and that is just easy fuel for the banking sector to continue to expand. What's been really the drag on the economy and on the markets as a whole for pretty much anything after, I'd say, kind of the April-May tax season, which was inevitably going to be a major headwind to the market, has been those bank flows. We've seen a complete collapse of the credit cycle. And if that's going to start back up, it's going to start back up because of the increased flow to the private sector in the form of savings that inevitably ends up in the banking sector. So we can see those bank flows kick up. I think you could make a really strong case for a hell of a rally to emerge. I trade my models. I trust them. They've proven themselves effective, and I'll be patient to allow this rally to come into its own before I get too over exuberant. But strong fiscal flows, an oversold market. I think a lot of people betting on a recession that if it comes, it's going to be minor, and it's looking more and more likely that it might not come. We could see a move in the other direction in quite a strong way. So that remains to be seen. That would be the bull argument here. Obviously, the data is going to do what the data does, and we will obviously make adjustments as the data comes out. You can see my Elliott count on the table right now on the chart in front of you. I'll do a couple quick ideas. This ABC pattern is kind of an alt count up to 4,600. It looks like possibly already we might be setting up for a fight with the debt ceiling that come December or the beginning of next year or something like that. So if we get a quick rally up to 4,500 or something like that, and we're facing some debt ceiling stuff heading into December, I think that could be a possible thorn in this market heading forward, and certainly fiscal flows get shut off because of a fight of the debt ceiling. That's going to be a problem. But otherwise, it's kind of my alt count idea at the very least. Get up to that zone again, assuming we get confirmation of the current rally and it kind of holds here. I'll show you in just a second some reasons reasons to believe that, maybe we shouldn't be buying into this too much. But other than that, those are kind of the initial thoughts. I still think even if we do make another leg lower into the future, maybe the debt ceiling pushes us lower, I do think my longer term count is finding a primary wave 2, either completing at that October low, or if for some reason we do hit one more wave of volatility, of instability, maybe possibly a little bit into the future, but this general 3600 zone likely the low, and then we'd start on the next big move. I do think will come about will be a longer term primary wave 3 of this next cycle going higher. So those are at least my immediate thoughts on the chart. Now, what I did want to show tonight is one of the two main models that I use. And as I pull that up, let me remind you, if you're not subscribed, get subscribed, turn that notification bell on as well. And then if you are subscribed and you do find this video helpful, give it a thumbs up. Much appreciated, helps the algorithm. So what I'm going to do is pull up my data dashboard here and pull up one of the main models that I use. And this is called the Vol Shift model. Give a quick explanation of this. I use two models to take all the data. I take all the data that I find that correlates well with forward market returns in terms of what I'm trying to measure. I put them in a Bayesian framework and let the math do its magic and spit out the model that's in front of you. And I'll kind of briefly explain how I use these in conjunction. So I have the MMT macro model. This measures fiscal flows, bank flows, kind of the gamma positioning of the market. Puts all those flows in a model, makes a prediction. Obviously, the green color means that it's in the highest quartile of predicted returns, red, lowest quartile of predicted returns. If it's red, it's essentially a bear market. If it's green, it's a bull market. And if it's in between, then it's in between. But with a Vol Shift model, instead of being kind of a forward-looking directional prediction market, this is a predictor of potential volatility, or really price variance. In other words, what is the expected variance of any day's move in the S&P going to be, right? So today was a very volatile day, or high variance day in the sense that it was a major move, whereas a lot of the days we had during 2020, 2021 were very low variance days, compressed volatility, where they were just kind of baby steps higher and higher and higher before volatility finally kicked in. So this is my Vol, like I said, this is the Vol Shift model. This takes into account things like volatility risk premium. This takes into account things like VIX contango, V ratio, a lot of different VIX metrics. It also takes into account dealer hedging through both GEX and some of the dark pool data. So it's really measuring what the components are of volatility and hedging and how they impact the market. And I call it the Vol Shift model because what I'm really looking for is a shift in the model. I'm looking for the signals that we're going to reach kind of what I'll call a full volatility cycle, right? Where we're going to get a build up from the beginning phase of a high volatility market into a compressed volatility market. And as it compresses, that usually creates a very stable rally during the compression of that volatility market. So what I look for is a shift from, again, we'll start after a big sell-off. I look for a shift into a new rank, and then that's going to give me the kind of predictive capacity to say, okay, it's likely that we're starting at the very least a bear market rally here. And of course, I want to see a couple days to confirm, but I use this as kind of an early signal that there might be some legs behind this rally. As you can see, the data goes back. The MMT macro model that I had up just a second ago went live at the beginning of this year, and as you can see, it's performed fabulously, kind of predicting the bear market, and that we've been stuck in the bear market. And then the Vol Shift model as well. You can see here, I can zoom in, came live a little bit after, a couple weeks after the MMT macro model, but same idea. It's been pretty darn good in anticipating the bear market rallies we've seen. And then as it rolls over and we get into a high compression zone and then come out of that high volatility compression zone, so the highest rank, meaning the lowest variance days possible, as we come out of those and we start to get into a more high volatility market, that's a signal that there's the potential that the rally is going to go ahead and give way. And of course, in a bear market, that means we're going to get a deep sell-off. But in a bull market, of course, you're looking at those high volatility days as potential reversal days using the vol shift model. So quick explanation of the vol shift. What I really wanted to show you is this has been the longest that we have been stuck in my vol shift model since 2020, and in the lowest vol shift rank, meaning the anticipation for the highest price variance sort of days. We're finally out of that phase and have been in essentially stuck in that rut. Like I said, for the longest time period since the post-COVID sell-off. So looking good here for definitely the potential of at the very least a bear market rally. Like I was mentioning, what's really dragging the market down, and I'll bring up the MMT macro model for this, is that we've just seen a complete collapse of the bank flows starting in 2022, really. We saw a bunch of headwind from fiscal flows completely collapsing as tax receipts came in April, and then May. Fiscal flows really just completely collapsed from that. We've seen fiscal flows start to pick up. I mean, they're actually doing quite well, even with the headwind of inflation, of course, as fiscal flows find their way into the private sector as savings. They do get diminished if inflation is higher, right? If inflation were to double, $1 yesterday is half of what it would be today if inflation were to double. But even with that, which this model does take into account, it's an inflation-adjusted fiscal flow. They're starting to look strong. The big thing that's holding everything down are the bank flows. But again, going back to that bullish argument that I just made, I think bank flows have. I mean, it seems as though there's fuel there for those bank flows to start to catch on fire again and see some expansion, or at the very least get the engine churning again and see some progress there. So I could see over the next few weeks the macro model be a little slow as those bank flows start to turn on, very similar to what we saw in early 2019, late 2018. We saw bank flows kind of collapse at both those junctures, and it took a while for that engine to start up. But I think we're making the baby steps there. And I think there's a pretty good argument to be made that we could end up seeing a bit of a surprise rally here. Maybe what's played out over the last 10, 11 months is maybe something akin to maybe what played out in, say, 1998, before the dot-com bubble really took off. I could see a case like that to be made going forward if a little historical analogy there. But in the meantime, I think the big thing to consider here is, one, everything I'm seeing, especially the bank flows, would still indicate that we're in a bit of a bear market, so no need to get overly aggressive here. But today's price action does definitely help get us in the right direction. Helps really. One of the things it really does too is it really just is if we can really kind of catch on, and this can go for another day or two, it's going to put a lot of pressure on the puts that have been opened for the majority of this year that have been a big drag on this market. The hedging activity, the negative gamma, the reinforced selling that's been an absolute drag on this market. As those puts give way, that can become a cascading event. That's where you get those short squeezes to emerge. So another day or two, what's going to happen, let me just back up. What's going to happen is we will get a brief pullback at some point as different models need to reestablish and balance themselves based on the move. Once we get that brief pullback, then the question is, are structural flows enough, and is there still enough push from the puts that were open that have been a drag on the markets? Are they going to continue to close out? And if they do, it's going to be a lot of flows and a lot of rebuying back from those dealer hedging positions that will continue to push this market higher. So I think the big takeaway for the night is, one, the vol shift model, which is my go-to kind of short-term model, did shift. We've had kind of one false positive during this entire sell-off, being back in September. So I mean, occasionally you get a false positive. It certainly is it works better if you get a confirming day following it. But the first step is there. Today's obviously a big day, and those are definitely, definitely setting up for the potential of a bit of a rally to emerge. But we're going to want to make it through tomorrow and get kind of a confirming move to definitely say that, yeah, we've got a good rally underway. And I wouldn't be surprised if it turns into something even more than just a bear market rally. So those are my thoughts for tonight. If you like what I'm doing here, like this style update and this information would be helpful to you, check out my Patreon page over at patreon.com/MMT Macro Trader. And I still have that $25 promo going on. Again, if you lock in at that $25 price, that'll be yours forever going forward. Eventually, I will raise the price, but if you get in now, you'll lock it in going forward forever. And I did put an update up tonight where I looked at all the charts, not only the equity charts, but also gave some thoughts on the dollar index, gold, oil, and bonds as well. So that update is live. Anyway, I'm going to wrap things up here for this market recap. And until next time, good trading, everyone. We'll talk to you then. Bye-bye.